I'm going to run through a pretty quick presentation, Frank, because I don't know what the hell's going on out there. So I'm not going to offend anybody's intelligence by pretending that I do. I'm just going to sort of make some observations. Plus, I have a lot of friends here with me today, so I do want to make sure we get through this and the block overall isn't too long. I mean, essentially, if I could use one word to describe the market right now, and I'm talking about the major markets here, not our tiny little corner of it, I just refer to it as fearless. I find it very interesting, the turn that we've seen in the last month or so. It's a combination of two or three different things, I think. One thing that's helped a lot, both in terms of, to some extent, institutional, but strangely, it seems more retail traders lately have gotten a lot more bullish. And one thing that's helped is, if you take a look at, this is basically the yield curve as of yesterday, and it's got, this is kind of the classic curve from a year ago, and you can see now the curve is starting to look a lot more like the classic rising yields with longer duration. In other words, it's uninverted in the last month or so. We've largely got, we've partially got the Fed to thank for that. Obviously, they pushed down short rates by cutting interest rates. That helped uninvert the curve. The other thing that's helped is there simply seems to be, one, a little bit more optimism about things like the U.S.-China trade deal, and some of what's helped is simply the fact that we're getting a bounce in yields that was long overdue. I mean, yields were getting ridiculously low, frankly. It was almost inevitable you were going to see everybody was on one side of the trade. When that happens in the market, reversals usually aren't very far behind it, and that's what we saw here. But that uninversion of the yield curve seems to have given people a lot of comfort. It's interesting, but I think if you look at things like CEO optimism, institutional investor optimism, it's actually they're actually considerably less optimistic as a group right now than retail traders. I think in part that's because institutional investors and CEOs understand the whole yield curve inversion thing a little bit better, and some of the potential implications of what happened. Because right now it's really retail that's driving that rally that you see on the right side of the chart that's taking the S&P to new highs. It's really not an institutional rally. Volume's actually pretty light. Market breadth is pretty light. It's mainly big name marquee stocks that are getting the buying. Basically the ones, the CNBC stocks, I guess, for lack of a better phrase. You know, all the obvious ones, Apple, Netflix, Microsoft, basically all the big guys. They're pulling the train again. And if you take a look at this chart, and this is just, what this chart shows you is, it's a 4-week moving average. There's a company called the American Association of Individual Investors. It's a fairly large association in the U.S. It's got a lot of members. They constantly do surveys of their members and track that. And this survey basically shows changes every week in essentially their bull bear. They've got this bull bear survey that they do every week. And what that shows you is changes in sentiment on a 4-week basis, and essentially if you're seeing those lines popping up, people are getting more bullish. If they're going down, they're getting more bearish. And it's interesting to see just how big a move we've seen in the last 2 or 3 weeks. There's been this very large jump. That's one of the biggest jumps they've had in years, actually. And again, I think it's mainly trade war and the apparent calming down of the bond market. That seems to be what's gotten individual investors a lot more fearless. And you know, it's really weird though, because if you look at the sort of the theoretical underpinning, the theory that tells you that yield inversions are a warning for recessions, that when you get a yield curve inversion, generally over 2 or 3 months, it doesn't really count if it just pops down and comes back up. It's really got to last for 2 or 3 months to be a meaningful signal. But there's actually two parts to the signal, and everybody seems to forget that. The second part to the signal that tends to signal that you're actually much closer to a recession, because the yield inversion as a signal, it could be 6 months out, it could be 18 months out. It's not great when it comes to timing it. But one combination that tends to come very close to the start of recessions is, in fact, yield curve inversion followed by steepening, which is essentially what we're getting right now. I wouldn't say it's strong steepening, so I can understand why a lot of people would look at it and sort of go, I'm not going to freak out about that yet. I don't know that we should, but it's something to keep an eye on. If you see the yield curve keep steepening, that's actually the combination that tells you you're usually pretty close to a recession. It's not just the inversion, it's the inversion followed by the steepening, and we seem to be in step 2 of that. I'm not seeing other, glaringly obvious recession signs, frankly. That's, I don't know that I want to hang my hat just on that one, but it is one of the few indicators that's had pretty much 100% success rate, which is unheard of, really, for economic indicators. You're lucky if you get 50-50. That particular indicator has a very, very good track record, which is why people pay attention to it. And if you take a look at this is just the 10-year yield chart. You can see that it wasn't falling yields. There was a lot of concern about the fact that the bond market yields were falling so much. There seemed to be so much fear in the market, so much buying in bonds, which is what was making those yields drop like a rock through the middle of the year. It seemed to really actually calm people down a lot, and probably should have, that we saw those long yields bottom out right at the end of August. They've bounced up and down 2 or 3 times since then. I mean, there's a variety of reasons for it. Partially Fed activity, partially, the trade deal's on, the trade deal's off, stuff like that. But essentially the trend has reversed. I mean, we're in an uptrend on yields now, and that seems to have calmed people down a bit. And unfortunately, as is often the case, the yields moving back up hasn't done us in the gold market any favors. It's not a big secret that bond yields, and in particular real bond yields, and gold prices tend to trade against each other. So the rise in yields that we've seen from this end of August, it's not really a surprise that if you take a look at this gold chart, the recent top in gold prices almost exactly coincides with the bottom in yields. That, and seasonality Seasonality is very positive. This is the most positive part of the year for the large markets. It's also positive seasonality for gold, or should be, but it's even more positive for the large markets. And we have seen a lot of liquidity injection in the last little while by the Fed that I'll get to in a minute. And essentially because of that, the run we've been seeing on Wall Street hasn't really been shared by the gold price, although I would say that given the number of headwinds against it, I'm not really that worried about the gold price. Gold really hasn't done that badly at all, given how much has been stacked against it in the last 2 or 3 months. I'm actually pleased to see that it's not down farther than it is. And again, as I said, it's not a coincidence the gold price basically topped out when we saw the bottom in the bond yields. It's also not a coincidence that we're seeing gold struggling as Wall Street is doing so well. If you take a look at this shorter term chart of the SPX, what's underneath it there is a correlation. It's basically a correlation line between the SPX and gold, and you'll see that through most of this period, almost all of it, the gold is negatively correlated to Wall Street, essentially. Wall Street's going up, gold price is going down. And because we've had a couple of big lifts on Wall Street during periods where golds have that negative correlation, it's not doing us any favors. And that's not an unusual, it's not usually that strong, but gold and Wall Street, as with gold and the US dollar, the correlation's never eternal, it goes back and forth. But it's not uncommon to see gold, because it's a risk-off asset, get a little bit of weakness when we're in a very strong risk-on period right now, where everyone's just reaching for risk. It's not uncommon to see gold flatten out during those periods, and that's essentially what we're seeing right now. It's not really, I don't think it's really about the dollar. I think it's about Wall Street and it's about bond yields. So does that mean, are we out of the woods now? Everybody should just celebrate we're going to have another 10 years of bull market? who knows? This is the strangest market I've ever seen, so I wouldn't discount anything, quite honestly. I'm not sure anything has a zero probability. I don't think it's likely, but I definitely wouldn't count anything out anymore. But as I mentioned earlier, you know, everyone's gotten happy because that inversion's ended, but the inversion followed by steepening is actually not generally a positive sign. That's generally a negative sign. Although the steepening wasn't, in my opinion, that rapid, so it's not something I'm really losing a lot of sleep over. But I don't think Wall Street's out of the woods yet. The other reason, of course, is that a lot of the positive sentiment on Wall Street in the last month or two has been assumed resolution of the trade war. I guess that's going to happen. It hasn't actually happened yet. From what I've heard of the agreement that's being negotiated, it's a bit of a joke, quite frankly, and it sounds to me like the U.S. is essentially caving. So I'm not entirely sure why, other than the fact that it's in their interest to do so, to see the indexes go up. I'm not really sure why Wall Street's celebrating what sounds like a pretty shitty trade deal to me. And I don't think we're completely out of the woods yet there. I mean, the guy running the States these days is a pretty emotional guy. I don't think China's or Beijing is going out of its way to piss them off at the moment, but you just never know. It does sound like they're being quite firm in terms of what they need before they sign even a mini deal. I mean, the stuff that you see coming out of sources in China that are generally very close to the government, they're basically saying we got to see pretty much a complete rollback of tariffs. You know, not just pushing them back a couple of weeks, but just stopping them, dismantling them, reversing the orders before they sign even the mini deal they're negotiating now, which sounds pretty minor. It's basically them agreeing to buy some more agricultural products. It's not much of a deal, but you know, I assume that deal is going to get done next month, but I don't think it's going to. Whether it's going to have follow through in the market, I have my doubts. I think when people see the actual terms of the deal, they're just going to go, well, I mean, that's not much. There's not much there. China's got its own reasons for its timing. I think they'd like to see some good news in December. You know, things are still pretty ugly in Hong Kong. They've got an election coming in Taiwan in January. I think they would like to get a deal done, but I don't think they're going to do, you know, unlike Trump, I don't think they're going to do a deal just to make a good headline. They're going to have to get what they want to sign it. So I'm not sold that we're going to see that deal yet. I think we will, but I definitely don't think it's guaranteed by any means. We are still seeing deceleration in both the U.S. and in Europe. Europe kind of dodged a bullet the other day. Germany managed to eke out a little bit of growth last quarter, so it didn't actually go into an official recession, but certainly things are definitely on the weak side there. The U.S., I think the current estimates I've seen for Q4 is probably 1% or less growth, so the deceleration I've been talking about all year is still happening. We've seen rollover in profits on Wall Street. None of this stuff seems to matter in the short run. It all just seems to be all about money flows and liquidity. And until we see that maybe reverse a little bit, I think it would take a larger shock. I mean, the fact that earnings are declining, no one seems to care. The fact growth is decelerating, no one seems to care. There's an inordinate amount of attention given to employment numbers in the U.S. I guess, you know, the one shock that might actually really roll things over and it would probably have gold take off like a rocket, would be a really large negative surprise on the employment front. I don't follow employment as closely as a lot of other people do for the simple reason it's a lagging indicator. It's actually a really lagging indicator. You're not going to learn anything about what the economy is doing by looking at the unemployment rate. It's 6 months ago. It doesn't actually tell you what's going on right now. But it is something that gets really heavily focused on. So that's the one thing I can think of, aside from the trade deal falling apart, that would be not good for Wall Street. Good for gold, but not good for Wall Street. A really big negative surprise on the employment, on the non-farm payrolls, would also be, even though it's a lagging indicator, it doesn't get treated like one on Wall Street. So if we saw that, that would also be probably a big negative for Wall Street and a positive for gold. The other thing that Wall Street's could help in it right now is this, and this is what you're looking at there is basically a chart of the size of the Fed balance sheet. So when you look, it was basically stable for several years after, QE1, QE2, QE3. It was stable for 2 or 3 years, and then starting about 2.5 years ago, they started QT, which was essentially the Fed buying back bonds and reducing the size of their balance sheet. Interestingly enough, although everyone on the FOMC insists that what they're doing in the repo markets is not QE, if you look at that chart, you'll note that 40% of all of the QT that was carried out over 2.5 years got reversed over the last 2 months. So although it's not QE, it does a very good imitation of QE. And I think certainly Wall Street and the bond market are both treating it like QE. And it's basically been a lot of the fuel, I think, that's driving the continued rallies on Wall Street and in some of the other markets. And has basically meant there's a fair amount of calm on Wall Street. Volatility is very low on Wall Street. Even with low volumes, you're seeing nice moves in the indexes. I think that calm, a lot of that emanates from this growth, renewed growth in the Fed balance sheet. I don't really know what to think about the repo market. I mean, at one level, I think it's a bit of a tempest in the teapot. I mean, there are statutory reasons for why they're having some issues in the repo market that have nothing to do with whether there's liquidity issues or anything. They're self-imposed liquidity issues because of some of the banking regulations that came in after the great financial crisis. That said, those things weren't happening until 2 months ago, and it's hard to believe that it's completely coincidental that those things are taking place now. And I would say that there is a market for buying forward repo contracts. And right now, that market is pricing in about a 3.5% overnight rate at the end of next month, which is pretty high. That's 2% higher than the Fed funds rate. So, I mean, that tells you that the people in that market are expecting some fireworks, which isn't unusual at the end of the year, because when you get to the end of the year, banks generally don't want to do that overnight lending because they all have their own liquidity tests that they've got to pass with the regulators. And it's a snapshot at the end of the year where, what's on your balance sheet, what are your assets, what are your liabilities. They don't like messing with their reserves close to year end. So things do tend to get more volatile even in a normal year. But I'd kind of be keeping an eye on that because there's obviously people in that market that are expecting things to get hairy towards the end of the year. So that could also be something to keep an eye on. The one piece of good news, I guess, with all the headwinds we've seen, like I said at the start of this, I mean, gold really hasn't traded as badly as it certainly could have, given the headwinds it's had. And I find this chart somewhat comforting. You've got two lines here. Basically, this is a performance, a perf chart. It just shows you the percentage change going back from the start of February. The red one is the gold price itself. It had a decent move. It's had a bit of a pullback. But what I find interesting is this is a GDX, the large producer gold index. It had a bigger move, which it always does. I mean, the miners tend to have bigger moves in both directions than the price of the metal. But what I find interesting is it's actually held up pretty well while this was really starting to fade. And we've actually seen a pretty nice bounce in it just in the last couple of weeks, which doesn't correspond to an equivalent bounce in the gold price. And in my experience, normally when you get a turn in the markets in either direction, when it comes to the gold sector, the miners lead the metal. In my experience, at least, normally if you're going to see a turn, you're going to see the mining company stocks move ahead of the gold price. I don't know why that is. At one level, it doesn't make any sense. And it certainly gives fodder to the conspiracy theorists. So maybe they're right, but that does just seem to be how it works. I mean, the miners tend to move ahead of the metal. So I find it encouraging that we've seen, relatively speaking, we've seen the GDX be that strong in the last couple of weeks. I think we're not too far away from another turn up in the gold price. There's any number of things that can make it happen, but at the end of the day, I don't care as long as it happens. Things are a little tougher, obviously, on the base metal side. It's no big secret, there's been big slowdowns in Asia, slowdowns in Europe. Those are the main demand areas. Longer term, the fundamentals look very good for base metals. I mean, they look great for copper. They look pretty good for nickel as well. Even lead and zinc actually have this weirdly positive thing going on where there's been some real smelter bottlenecks develop in the last few months. And it's largely because China has been really cracking down on some of the really nastier, more polluting smelters. This stuff never gets taken seriously by Western analysts, but I've never thought they were kidding about this, and it certainly doesn't seem they are. I mean, they're forcing mergers. They're telling several of the larger smelters in China, like, you're done. The pollution you guys are creating is just too offensive. There's no way to fix this. You're shut. That's created a bottleneck of concentrates. And what that means essentially is that, certainly in the lead and zinc space, it's definitely been a buyer's market for the smelters. And the way that smelters make money is they charge miners what's called TCRC, treatment charge. They're basically treatment charges. This is what we're going to charge you per ton to turn your copper concentrate into copper, your zinc concentrate into zinc. Because, of course, end users don't use concentrate, they use metal. Right now, the TCRC charges in the lead zinc space have gone, and a lot of these smelters are in China. They've gone from 100 to 150 bucks a ton. They're over 300 bucks a ton now. They're expected to be 400 bucks a ton early next year. It doesn't look like there's going to be any kind of let up. That's part of the reason why you're definitely seeing a drawdown in warehouse stocks in London and in Shanghai on most of the base metals. And if this goes on for a while, and it sounds like it will, it sounds like Beijing is dead serious about shutting down some of these smelters. If there's no new capacity to replace them, at some point these TCRC charges, they're at the point now where they're definitely starting to bite. If you've got a marginal operation where your grades aren't that good, or you've got an operation where essentially, and the best example I can think of this is an operation called New Century in Australia, which is actually reworking the tailings from the old Century mine, which was a massive zinc mine. By all accounts, they produce shitty concentrate. It's very dirty. The grades aren't quite as high as they should be. And in this kind of market, smelters can really boost the charges for guys like that. So I think you may actually see some drawdowns on the supply side. You may see a few places shut, which I didn't really expect until very recently. But it's actually made me a little more positive about the base metal space, even though I think we've got to get through this China stuff, because really this is the 800-pound gorilla when it comes to base metals. That's an activity index that Bloomberg's been doing for years and years and years for China. As you can see, it's pretty much a one-way street, and it's not going in the right direction. The Chinese economy's been slowing for over a decade. It certainly isn't accelerating right now. It may start picking up if this trade thing ever gets settled. But in the short term, that's basically the problem in the base metal space right there in one chart. That will end. You will end mines close. I mean, the supply-demand picture, even given relatively weak growth in China, is still quite strong longer term. We're just going to have to get past this bump, that's all. So I'm way overdue, so I'm just going to, it's pretty obvious where I've been going here. Gold's going to get the most traction for a while in terms of investment dollars, in terms of gains when they generate good results. I think gold explorers will continue, and basically same goes for silver, will continue to get the attention in the short run. I mean, gains will come out of exploration news. Once we do get another decent leg up in gold and silver, you'll see a lot more money flow back into producers and especially developers. But I don't think we'll see that until we see 10-20% move in the gold and silver price. You'll see a much larger move in the developers and producers. But until that happens, explorers is probably where the action's going to be. Base metals, like I said, good supply demand longer term, but short term the market's just not giving them any love. I don't think there's that much most can do about that, although again, if you've got a story that's got real scale potential and is generating good results. And I got two of those sitting next to me. Those guys can still definitely get traction even in this kind of a market. It's been a tough financing environment. It's got things really cooled off in the last 4 to 6 weeks, but I am still seeing decent sized financings get closed, and generally the ones that have been working the best are precious metals, and generally on top of that higher grade precious metals. Those companies seem to be able to pull in cash, but on the base metal side and on the kind of lower grade bulk tonnage side, a lot of those guys have had a lot of trouble pulling in money, and I don't see that changing right away until we see move in the prices. So for the time being, for me, it's exploration, preferably high grade or large scale, very strong management group base metals. That's where I'm going, and that's not coincidentally who you're about to hear from. And were you guys nice enough to sit in order so as not to confuse me?